Founders Forum, Episode 11.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Hey, everybody. Welcome to another episode of the Founders Forum. Today, Cole and I are going to be speaking with Peter St. Onge, who is a Mises Institute Associated Scholar, and he's also an Economic Research Fellow at the Heritage Foundation. Peter got his PhD from George Mason University and has done a bunch of work on the financial sector. He's done a lot also on Bitcoin in particular. So what we talk about basically, what's going on with the banking problems, the Fed's ostensible solution, FDIC coming in and backstopping all the accounts, and to what extent, if any, cryptocurrency provides a safe haven. Let me just mention before we dive into it, there's a part somewhat near the end of the episode where I get all excited. And what happens is Peter is talking about the problem with fractional reserve banking. And so I'm going to ask him at some point, well, hey, do you have any real world recommendations instead of just, science fiction stuff where we have a completely different world? What can regulators do in the real world relatively soon to try to make things better? And he explains how the way you could achieve a system where some banks or certain accounts with banks that are legitimate demand deposits, checking accounts, are backed 100% reserve, with money in the vault or on deposit with the Fed, I guess, as opposed to the current system where, the bank lends your money out even if it's ostensibly in your checking account. My money's sitting there in the checking account, and no, it's not. So Peter's point was that you don't need massive new legislation. You don't need to get rid of the Federal Reserve or anything to achieve that. All it would take would be taking existing suitability rules and applying them in the context of checking accounts. So like right now, if you want to open up an account with Charles Schwab so you can trade options or do shorts on stocks and whatever, you have to take like a test or whatever to prove you understand what the heck you're doing, right? They want to make sure you understand what you're doing before they give you the ability to trade on these accounts and whatnot. So likewise, Peter's saying they could just require that if you're going to open up an account with a bank where your deposits are lent out, so fractional reserve basis, that before they let you do that, they have to give you a test for you to demonstrate that you do understand what's going on, that you realize that my money's not in the vault. And in fairness, some people might say, well, doesn't everybody know that? And yes and no. And so we get into that there's a sense in which everybody kind of knows, yeah, the bank doesn't hold my money, but yet at the same time, if you went to go get your money out and the bank said, sorry, we gave it to somebody who applied for a mortgage and now we don't have it, you would probably be upset. So that's what we get at near the end. So without further ado, here is our discussion with Peter St. Onge. Well, Peter, welcome to the Founders Forum.
Thanks for having me on.
Yeah, glad you could come. So I know Cole and I are excited to talk to you. I was telling him that you've been posting a lot on social media lately, of course, about the banking situation. So again, for our listeners who may have missed some of the previous episodes where we had similar themes, in your mind, is this a big deal? Like, SVB going down, the Fed coming in with their rescue package and whatnot, or is this just, oh yeah, these hiccups happen every once in a while, or is this qualitatively different from recent events?
Yeah, we were talking about this the other day, but I think it's sort of unique in the sense that the individual problems, right? If we look at what's happening with SVB or Signature or Credit Suisse or Deutsche, each individual shouldn't be a catastrophic event. These are banks that are run poorly for one reason or another. They're regular storms that, any industry experiences. But in this case, I think that they are magnified because our financial system is extraordinarily fragile. It's fragile in the best of times, but at the moment, because of the twists and turns that central banks went through to enable COVID lockdowns, our financial system is extraordinarily imbalanced, out of whack. And so what should be regular storms, I think, are magnifying into each one is sort of world-threatening.
It just from your comment there, you mean that in order to facilitate so many people staying home from work for such long stretches, the only way that was going to work was with the government paying them. And then how do you finance
Yeah,
that? The central banks created the money.
exactly. I was in Canada, for example, in the beginning of the pandemic, and we had CERB, which was basically a UBI. There were many people
What
who
the
were
CERB,
paid.
is that an acronym? Does that stand for something?
Yeah, that's an acronym for. It was basically a monthly payment. I believe it was 2,000 Canadian,
Uh-huh.
which is pretty good money.
That's right. It
Yeah,
was. Yeah. The CERB.
and
Canadians love the CERB. No, Canadians would literally be like, so I'm Canadian citizen, almost not. Well, I'll always be a citizen, but almost non-resident now. I'm working on that. Very close. Resident of the Bahamas and working resident in the United States. But literally so many Canadians, even one of a couple of my family members were like, hey, as COVID was ending, how's work going? Nah, I'm on the CERB.
it was a lifestyle. And, it was very relaxing. You would stay home to save lives and get paid for it. You don't have to wake up in the morning. You can play video games, spend a lot of time on Netflix. And, of course, that was duplicated here in the US as well. So, the unemployment benefits were extraordinarily generous. There were no questions asked on going on Medicaid. They just approved anybody. And all of this was extraordinarily expensive. Then, of course, on top of that, you had various tax revenue plunges because they were shutting down entire industries. And so if an industry is not functioning, it is also not paying taxes. So, absent central banks, they wouldn't have been able to do either. And I think that the reason those are so important is that all of those benefits, right, paying people to stay home from work, that's quite attractive to enough voters that it swung public opinion from being against the lockdowns to for the lockdowns. So in a sense, I'd say that central banks essentially bribed populations to lock down their countries, incurring on a worldwide basis more than $10 trillion in debt. That's a significant hunk of the accumulated wealth of humanity in order to buy these lockdowns. And, of course, those cost inflation. In order to fight the inflation, central banks all over the world yanked up rates at imprudent rates. And so now we are starting to see the fallout from that.
Well, it's interesting. It reminds me, I was doing research for my book on money mechanics for the Mises Institute, and I was reading some old school, and like going into World War I, when it first broke out, there were many serious analysts who thought, oh, this thing will be wrapped up in 3 months, because they thought it's going to get so expensive, they're just going to have to. And they didn't realize that all the belligerents were going to go off the gold standard. And effectively, their central banks were going to monetize it. So that's part of the problem with central banking, is that it allows them to sort of make it seem like government policies are cheaper than they really are.
Exactly. And World War I is, I think, the iconic example. It's a great example. I call it the venture capital of the crisis industrial complex. Whether it's war, whether it's pandemic, whether it's magnifying some regular storm into a catastrophe, they provide the, financing to get it up and running, and, to get it to the point where it metastasizes and it actually is a crisis, at which point now people are begging for government to do something about it. It's quite a hustle.
It does seem like there's been a lot of perfect storms lately. It's sort of like there's great inflation. I'm like, come on, we got to have a higher standard for perfection here.
And
you would be able to say, Peter, that there's then for the listener who would probably want to be able to draw some kind of a parallel, say, between the quantitative easing that existed, that occurred during, say, COVID. And I mean, everyone, I think the average listener, the non-average listener understands the BRRRR and the printed money. And I think that kind of analogy kind of leaked out into kind of like what I call retail, or even like popular culture. It wasn't just for the libertarian or the conservative, or the person who had a deeper than average kind of monetary idea. I was actually impressed by that. I think it was actually quite fascinating. Sure. So are you saying that potentially that the failure of the banks, the three S banks in the last month or so, and potential bigger banks down the road, are kind of a byproduct of the BRRRR? It kind of, in a way.
Sure. Yeah, absolutely. And the irony there is that sort of the average Twitter user who comes across the BRRRR memes, I think, is no doubt better informed than somebody who diligently reads the New York Times and maybe even the academic literature, if you weigh all of that esteemed knowledge on one side, and then you just look at the Burr meme, oh yeah, Burr meme's closer to reality. Yeah, I think that's exactly what happened. In order to fight the inflation, they raised rates at the highest rate since the 1970s. No matter what school of economics you belong to, you accept that hiking rates extremely fast is going to lead to a recession. And I mean, that was intentional. Jerome Powell was quite open that what he was doing was to strangle the private economy to get them to stop spending, because that was easier than telling government to stop spending instead. And the spending had to be cut by somebody. It's easier to kick the dog than it is to kick your boss. And so that's what he did. He had multiple speeches complaining that there are too many jobs. And, but at any rate, so hiking the rates in order to crash the real economy, that has consequences. And, the sort of standard line is they're going to keep hiking until they break something, and they broke something. Now the question is, they're going to break a lot more things, right? We've already seen drama out of the UK where a number of major pensions, were in danger of breaking. The Japanese yen has gone through contortions. There's a new BOJ chair on now who might be changing that. We could start to see instability come out of Japan. There are many, many things to break. And I think that's sort of the meta lesson here that should concern people, is that if we look at the last world-threatening crisis we had in 2008, these did not come from things that people were watching. Right? So if you ever watched the movie The Big Short, Burry's running around trying to get people to price these CDSs, and all these Wall Street guys are like, what is this thing? I don't know. Charge them a quarter, charge them a dime. I have no idea. Okay, so the point being that the sort of moving parts of that, MBSs, CDSs, this is not something that all of our regulators were sitting and watching. This was like it popped out of nowhere. In the beginning of 2008, you guys will remember, there were all these explainers in the Wall Street Journal. What is this? What is that? What is a money market, right? So I think it's quite likely that in the next crisis, it's not going to come from what everybody's talking about. It's not going to be what was in the news, what the Fed is watching, what the regulators are watching, what the prudential authorities are watching. It's going to come from out of the blue. And the problem is, how many out of the blues are there? Right? Our financial system is far more leveraged than it was in 2008. Every single crisis, we sort of put these new incentives in there that nobody really knows what they're going to do. You just kind of stick it in and see what happens. If it's a problem, we'll fix it along the way. We actually saw this in late 2019. This was actually before COVID. We saw drama in the repo markets. Bob, I'm sure that you were commenting on at the time. And that popped out of the blue. And again, with the explainers. And so my concern here is, sure, these are the things we can see so far. These regular storms being magnified into every single one as a perfect storm. But my bigger concern is we can't see what's going to break next. How many ghosts are in the machine? How much worse does it get as we pile on debt and as we pile on yet more regulations that don't interact with each other? Bob and I were talking the other day, right? If you're taking too many prescription drugs, right? You go to the doctor, he can tell you if you're taking 3 drugs and you've got some interaction. What if you're taking 50, 100, 500, 3,000 drugs? That's our financial system. We don't know what's in there.
Peter, you said something a minute ago, and maybe if you could just elaborate. So you were saying how Powell was complaining there were too many jobs and so on. And I think in our earlier conversation this week, we had talked about Jon Stewart, the Daily Show guy and he recently, I don't know if you saw it, but he had Larry Summers, what was he, Treasury Secretary under Clinton, and sort of the staid, I just no nonsense guy. By the way, I'm not making fun of him. I think Summers actually is courageous because he was coming out and saying warning about price inflation when everybody else was mocking him. But anyway, and there was and Stewart's point. So again, it was the kind of thing where it wasn't so much that I agreed with Jon Stewart's ultimate worldview, but he was noting apparent hypocrisy or some funny, irony in. That is, so let me just recapitulate what the argument was and have you respond. It was along the lines of saying, you guys kept talking, for a year plus about how, we got to raise the unemployment rate. We got to cool off the labor market. That's the only way to get inflation under control. And so you're hiking rates and doing all that. And sorry, people got to suck it up. And this is the only way. But the moment the banks get in trouble from rate hikes, all of a sudden it's like, oh my gosh, we got to stop the presses. This is inconceivable. That a bunch of people who have accounts more than 250K might get hurt. And, and Larry, sort of, and it was given his thing. But so how do you So for one thing, can you just comment like in terms of like where do economists come from? The very idea that unemployment, the labor market could have something to do with the price inflation, but then beyond that, are they just flat out hypocrites by talking like that?
Yeah, I think they absolutely are. They kick the dog and they compliment the boss. They're sort of central banking. It relies on the existing financial system to steal money, and they're very, very concerned. The metaphor that I like to use is a gasoline thief, and he sneaks out every night and he takes a gallon out of your tank. And it's very, very important for him, extremely important that he does not take 3 gallons, okay? Because you're going to figure it out. All right. He's got a good thing going. If you look at the growth in the money supply, it's not 2%, it's substantially higher, right? We would inherently have deflation because our population is growing and our economy is, believe it or not, still gaining in productivity. They are stealing a nice chunk of change out of this. They want that to keep going. And so they're interested in what will get them in the newspaper, what will get political opposition ginned up to making politicians change the game. They want to protect the game above all. And commoners, that's just collateral damage. That's not their problem because they're not judged by that, right? They can always find some excuse. You've got greedy companies who, are laying off people before Christmas. I mean, they have a cooperative media. They frame these things. And, I think they rely on the fact that the vast majority of people do not understand how central banking works. They have no idea how they're being fleeced. And so, their overarching goal is to protect the scam. It is not to protect the people.
Is there a country, that question for maybe both of you guys, it just kind of came to mind. Is there a country in the world that seems to be getting this more right or maybe less wrong than anyone else from a central bank perspective? Is there any country that kind of comes to mind?
Japan is complicated, and Bob, you may have smarter thoughts than I do. But Japan is interesting. I think from a monetary perspective, during COVID anyway, Japan did not have as strict a lockdown, so they did not have as much inflation come out of it. Their rates did not, fluctuate as much as they did in the U.S. and Europe. Now, of course, the background in Japan is also that they've been maintaining these low rates for so long that they have this substantially zombie economy. So, not to praise Japan broadly speaking, but I think during the pandemic, Japanese banks don't seem to be in as much trouble. And then Switzerland, I actually don't know enough about Switzerland during the pandemic. But anyway, Bob, if you have any other thoughts for countries that might have done better.
So in terms of recent years, no, not off the top of my head. Was it right after the financial crisis? I think, was it Iceland that just kind of let the banks go down, like more or less?
Yeah, which is glorious. Yeah,
and so like so Cole, that would be the only example I could think of where a country people have heard of that had a decent sized economy did something that was, and what was, and the reason I know that is because the podcast I did with Tom was the Contra Krugman. We were going in the beginning, Krugman was like, "This is inconceivable. They would let what a bunch of reckless fool." And then afterward, he was like, "Yes, all the response. We all said how that was the right thing to do to punish the bankers and blah blah blah." So. Anyway,
he has a Nobel in public relations, so yeah, right.
So to answer your question, like Iceland after that, they didn't just bail out all their banks. They kind of, it wasn't like pure laissez-faire, but they did let a bunch of banks go down, even though people were warning at the time, you can't do that. That's inconceivable. Your economy will wreck for a decade. And then when they emerged better than, their peers, everyone was like, oh, well, yes, we all always knew that was the right thing to do, and don't bail out the bankers. So
yeah, and this is kind of a meta argument for smaller government, right? Just as a smaller government could never have done COVID lockdowns, right? It wouldn't have been sustainable. Also, a smaller government can't bail out the banking system. If we look back to 2008 and we sort of ask the counterfactual, what would have happened? There were many banks who would have been willing to buy Wall Street out of bankruptcy. Canadian banks did not get hit nearly as hard, and they have a surprising scale. Warren Buffett was interested. He was sniffing around and sort of bottom feeding. You can imagine banks in many countries that are better run, perhaps Swiss banks, that would have bought them out of bankruptcy. And so, this would have, they would have served as a warning to bankers to come. Don't do this because this is what will happen to you. I don't know why we, as a matter of public policy, have any sympathy towards the, individual bankers who crashed the world And so clearly that's what should have happened. It's what should be happening right now, of course. But, again, the bankers, they have Rolodexes, they have extremely expensive lobbyists and lawyers, and they have a seat at the table when we, the people, do not.
Can I ask you, Peter, this is the Founders Forum, so we have a lot of business owners listening. What's your take on, of course, you don't endorse what the Fed and the FDIC did, but did that put the fire out for the foreseeable future? Or do you think that, oh no, that there's still, the other shoe still has to drop?
I think there are probably more shoes to drop, but the way that they structured it is, I think they communicated to the market that bank depositors and counterparties are going to get taken care of. So they've communicated that they're effectively going to bail out whoever it takes, and that that will eventually be converted into inflation. But of course, they're betting that that'll be delayed long enough that they can find some other excuse why it happened. So I think that we'll probably see more banks in distress, and this is of course, here we're only talking about the U.S., right? So other countries haven't necessarily committed to these open-ended bankruptcies. I think that we'll see more banks in trouble. There was a study the Washington Post wrote it up maybe a week or two ago, that estimated that about 200 banks in the U.S. are in distress. And what's causing all this distress is those interest rate hikes fundamentally, right? So the vast majority of bank assets are held in bonds. If you raise rates really quickly, then those bonds lose value. And so, whereas the bank used to have $1 in the vault, now it's only got 80 cents. So I think that fundamental issue, which is caused by sort of the rates yo-yo, I think that's going to be showing up all over the world, one after the next. And in each case, the question is going to be, are those governments going to do the kind of open-ended bailouts that they did in the US? But I think that so far, absent Janet Yellen's confused musings, the message has been pretty clear that everybody is going to get taken care of. And we can expect that to continue, at least unless the crisis gets real big, at which point, at some point, they start picking and choosing who they bail out, presumably.
Yeah, and then they get, taken care of by more burr money, and then it just continues to go around and round. So, if I'm the average business owner, watching this, I'm thinking to myself, okay, well, I have more than $250,000. I've learned that FDIC will insure me up to $250,000. I have more than $250,000. I've worked my entire life to acquire these retained earnings inside of this bank account, this warehouse of capital. Well, what the heck do I do? Is my bank next? Would I call them up and say, hey, Bank XYZ, are you okay? Of course they're going to say yes. Or, well, no, business owner ABC, you should probably take everything except for $250,000 out.
Yep.
And you'll be. So then the idea comes up of bank diversification, bank account diversification.
Absolutely.
Right. So then you would have $250,000 in, but then
each bank, right?
Each bank, right? And then Bitcoin comes up naturally. I'm wondering, maybe is Bitcoin coming up for people as an option?
Yeah, Bitcoin, certainly it is in the public consciousness. Bitcoin famously has a extremely committed army of fans. And it's an interesting asset because I think from a company's perspective, you have two areas where Bitcoin could be interesting. One of them is as a treasury asset. The other one is as a medium of exchange. So I think treasury asset is a little bit simpler. Most companies are going to hold their treasury assets in local currency just because of transaction costs, maybe accounting reasons, different rules. But fundamentally, if you are trying to diversify your treasury out of your local currency, then, you're interested in how much does it fluctuate and how much does it correlate with your other assets, but above all, with your core business, right? You don't want to have an asset that actually magnifies the risk inherent to your business. And then there's that sort of diversification question, and then the different features of it. And then, of course, as an investment, I think sort of the meta theme on Bitcoin is that it behaves a lot like gold. It's sort of gold on steroids. It goes up a lot more than gold. It goes down a lot more than gold. It is super gold. It's interesting, I think, from a company's perspective, just because it is possible to actually store it in-house. Right? If your company is keeping a large share of treasury in gold, you're probably not storing it in the supply closet. You've got to have some kind of dedicated space, which Now, I don't know. Now you have to have armed security and headquarters 24/7. So from the storage perspective, it's certainly interesting. And then, of course, it's a question of what the local regulations are, and that's going to depend on the place to what degree regulators accept, especially if you're a publicly traded company. Then how do you report that? Things like that. And then I think the second area where an asset like Bitcoin is interesting is medium of payment. And there, I think the sort of killer app is the Lightning Network. There was a sort of demonstration. They had this moment at a place called Bitcoin Beach in El Salvador, and there are a bunch of fans down there for a conference. And so they all transacted, like they all sent each other one sat or something, a minuscule amount of money. And in aggregate, something like, I want to say 500 transactions, a very large number of transactions. And it cost in aggregate, something like 12 cents. Okay. Lightning Network is essentially free. It's instant, it's free. The way it works is sort of a distributed, it's a bit like BitTorrent, if you remember how that works. So everybody's sort of participating in it, but you don't have any security exposure. So it's like almost a crowdsourced daisy chain, how you pass money around. At any rate, that I think is quite fascinating. It's not super interesting for most businesses because most customers aren't familiar with it yet, but it's spreading, and sort of the core of the technology, right? If you compare a 40th of a penny to credit cards, to how much time it takes to process a credit card, you're talking, I think it's 1% or 1.5% plus sometimes a fixed amount. It is astoundingly cheaper. It is much, much faster. It also can't be reversed. For some businesses, this is an absolute nightmare, the chargebacks. So I think Bitcoin is interesting, but I think for the most part, it's the kind of thing you keep an eye on. Unless your treasury has need of, some kind of asset that has that correlation profile, I think in general, we're probably at the keeping an eye on it stage.
Yeah. I mean, day to day, you're right. It probably makes more sense to diversify 250,000, 350 in a bunch of different banks and pile everything into Bitcoin and have to rely on how to figure out, what exchange. Geez, I heard all this stuff about Coinbase recently. Should I buy it there? And even though it's a publicly traded company, is it safe to leave it in a hot wallet on the exchange, and then I could then distribute it and make my payments, and can I get paid? And, I mean, it's really confusing operationally day to day. I mean, businesses need access to cash every day. It's for the average person. I mean, it's doable, but you kind of have to go to Bitcoin University to figure it all out.
That's
Business
the thing.
owners don't. Yeah, they don't have the time to do that.
Yeah, that's the thing. And you're absolutely right. The absolute first thing that any small business owner has to do right now, I mean, like before you have your next meal, you have to diversify your bank accounts. You've got, do not have too much money in one single bank, not in this environment. Maybe it'll get bailed out. Maybe it won't. You can't risk the company on that. But, to your broader point on Bitcoin and the amount of knowledge it takes to master it, never as a business owner, but even as an individual, never own anything that you can't sleep at night. This is like your spidey sense going off. Don't own it. And not only, is that a kind of eat your vegetables moment, but there's actually a legitimate reason for that, which is that if, for example, you put $100,000, the kids' college fund in Bitcoin, and it goes down, let's say it goes down 20% over a weekend, you are going to sell. Unless you absolutely believe in it and you understand through and through and you are committed and you've decided this is the future of the world, you are going to sell at the bottom. And then you're going to read another article and then you're going to get excited again and you're going to buy at the top again. And this is how to lose your money. This is how to turn a large fortune into a small fortune.
Totally. Yeah. I mean, it's like exposes kind of that whole idea. Bitcoin has exposed this idea that's existed just in the stock market that you described in general to a whole other level. I'll just share really quickly for me personally in my businesses, what I do and what allows me to sleep at night is using life insurance. I mean, I pile all of my net worth as quickly as I can now in 2 different countries into life insurance. First heard about it, I was like, too good to be true. Why are more people not doing it? What's the government going to do when they catch on to this loophole? Researched it, took me about a year to get confident. And then I just started moving all my money out of banks and moving it all into life insurance. And I sleep pretty good at night, I have to say. I mean, I still have to trust life insurance companies that there won't be a run of the life insurance company. or some kind of crazy black swan event where a life insurance company has to pay out an exorbitant amount of death benefits and they go insolvent. But for the most part, I think I would pick that over bank diversification, Bitcoin for me. But that's pretty much all I own now is, Bitcoin and life insurance. Has that concept ever crossed your desk at all?
Yeah, well, I mean, sleeping at night. Yeah, I think that's this is the number one goal in life.
Right.
Yeah, I mean, I would. I managed money for many years, and my blood pressure was horrible. I did not enjoy doing it. The money it is not worth it. It is very hard to put a number on sleeping at night. And if you are a small business owner, look, you're doing fine. Okay, you're not eating ramen. You're not changing your own oil. I mean, you're doing all right, okay? You don't need to go chase this money and give yourself that kind of headache. Focus on your business, park it somewhere where you can sleep at night.
Peter, can I go back to something just to, again, the virtue, because this is something that came up as I was posting on problems with SVP, and I was like, I was just going through the basics back when the story first broke, just making sure everyone understood. Yes, when interest rates go up, bond prices go down, and then blah blah blah, and of course the Bitcoin fanboys were coming in and saying Bitcoin solves this, and I thought they were at first I thought they were saying you can't have fractional reserve banking with Bitcoin, which isn't true. And I was pointing out, look at Mt. Gox and da da da. But then they clarified, and I understood their point was that the problem right now is that people using dollars, let's say, because there were a lot of firms that they had their payroll at SVP. And so they were coming and said, look, we had above 250K, but not because we're fat cats, but because we have 50 employees and we don't want to have it in 16 banks, to pay payroll, you know what I mean? Like, blah, blah, blah. And so the Bitcoin guys, their point was to say, with Bitcoin, if you want to, as long as you hold your own keys, it's not that you need some other entity involved to move it from one person to another. So you said it's like gold on steroids, and I think they would say, if in addition gold had the ability that on its own accord it could be teleported to anyone on Earth, that you could just plug in their address or whatever, and then so if gold could do that, wouldn't that be even cooler?
Yeah,
you wouldn't,
absolutely.
So anyway, so do you want to just respond? Because I know you're a fan, but I just want to get that element out.
Yeah, for sure. That's one of the things that, one of the superpowers of Bitcoin is that it is inherently full reserve banking. It is a bearer asset. It's like walking around with gold coins, but these are gold coins that you can transmit for 1/40th of a penny worldwide. It really is super gold across the board. And it's topical, of course, at the moment that we're talking about, fractional reserves failings and these sort of ongoing financial crises that fractional reserve keeps causing, that it would be nice if we had a system that actually didn't need these intermediaries. Intermediaries, of course, bribe politicians. They rig systems. And so, not only is it a question of will the intermediary fail, but will the intermediary rig the rules in order to fleece you, which is what commercial banking is. So I'm a massive fan of importing the Bitcoin model of, not your keys, not your coins. It's a bearer asset. You don't need an intermediary. You can use one if you like. So I think that is the future. Now, of course, at this point, the percent of people in the world who are primarily transacting in Bitcoin is still small. And so it's going to take some time of proselytizing and educating before we can flip whole scale over to Bitcoin. But hopefully that goes faster. And, experiments like, or reforms like what Bukele did in El Salvador, right, where he made Bitcoin dual legal tender. I think that was absolutely fantastic. I was really thrilled to see that. It would be great to see that happening in other countries and then see more and more trade going on that's actually, completely stays in the Bitcoin world as opposed to having to interact with fiat at all.
Also, can I ask your perception that one thing I noticed about this time around, as far as because you guys were mentioning how the money printer go burr, like that's becoming more mainstream, and people are like normal people who are not ideological. It's not that they had a problem with, they might not even know what fiat money meant 3 years ago. Yep. They get the stuff done. What I've seen for this particular crisis now with SVP is a lot of people are asking about fractional reserve banking. I mean, I don't know if you saw the testimony, Peter, but
for sure.
like was it a senator was asking
Senator
somebody?
Lummis.
Yeah. I mean, can you, anyway, do you know the details of that exchange? I think I might even seen you post it, or maybe Caitlin Long did, but.
Yeah, she was asking, it was the Fed vice chair for supervision, and she was asking whether fractional reserve makes our financial system too fragile, which of course it does. That's the whole point. The Federal Reserve was designed because fractional reserve made the banking system too fragile in 1907. And then they said, okay, never again will we pay for such things out of our pocket. We shall pass this on to the taxpayer. So yes, it is structurally, it is meant to fail over and over. And every time it fails, it's going to charge you a couple trillion to bail it out. So that was, glorious to see a senator actually raising that. And her staff, I know some of the members of her staff, they know exactly what they're asking when they ask that, which is Bitcoin is the path. Bitcoin is the way to go with this. If I'm open to gold as well, I love gold equally. Indeed, if we were to flip over next Tuesday, that it would have to be gold realistically, because, again, most people don't understand Bitcoin. And so they're going to sell at the wrong spot. They're going to get ripped off. They're going to lose their life savings. But in the grand scheme, I would love to see us move towards a hard system, and specifically a hard system where banks cannot pretend to have money that they don't actually have, sort of this structural fraud that they perpetuate, where every single time that people actually find out about that fraud, we end up, having a banking panic that then seems to require trillions of dollars of taxpayer bailouts.
Yeah. So it was interesting because I can't recall. I mean, I know Ron Paul obviously would have that view, but I'm not even sure if he ever just started asking people about, he would say stuff like, would you say gold is money? He's had some famous things like that, but maybe I'm wrong. I don't remember ever seeing him drill somebody about fractional reserve banking per se. Or am I wrong? Like, do you remember a time?
I don't recall a time, but I think that, this represents the dynamics have shifted. I mean, there is, especially among young people, there is an absolute army of people who, it's like once you understand Bitcoin, once you orange pill, you do not go back. I mean, and, Ron Paul, he was doing his best, but at that time, there were not that many gold bugs in the US. And, I think they were committed, but the fact that we didn't have social media, for example, back then just meant that they couldn't find each other. They were all sort of voices in the wilderness, people who loved gold, but they probably figured they were alone. Now, of course, with social media, all of the Bitcoiners find each other and they interact and they encourage and they egg each other on. And it what do they call it? The murder hornets. So I think it's thrilling that, Cynthia Lummis can go in there and she knows that there are millions and millions, tens of millions of people backing her up when she goes in and asks those, pressing questions. So I think it's exciting. I think it's a sign of the time. And like the 2008 crisis, as bad as the crisis is, a silver lining is that people are actually seeing how bad the system is, how corrupt it is, how intentionally fragile it is. And, from 2008, I know that for the libertarian movement, for the hard money movement, it was, really, it was a moment that drove a lot of people to start understanding this stuff. And of course, Bitcoin came out of the 2008 crisis.
Right.
Literally, the Genesis block referenced the bank bailouts, ironically enough. So in a sense, this is sort of what Bitcoin was built for. So it is quite exciting to see how Bitcoin does and how the community sort of proselytizes, spreads the education, spreads the word.
Do you have any thoughts on that, Cole, from your perspective? Are you seeing, like, quote, normal people talking about fractional reserve banking and like in ways that would have been relegated to academics or?
Yeah, totally. I mean, that's why I brought up the whole birth thing. I mean, I think it has to kind of get so bad before it gets good again. And I think this is kind of an example of it. I think that, like, again, I call it retail end users, the average people, average folk are using terms and are becoming more aware. I'm getting phone calls from friends or texts. People know that I'm in this industry and I'm kind of in this world, asking me questions they never would have asked me a year ago, for example. And I'm very inspired by it. I tend to be an optimist, for sure. And I'm optimistic that this is the light at the end of the tunnel. It's just
Mhm.
kind of coming to terms. Well, did they know what the idea of quantitative easing, just that term alone? And it's interesting too, because when people start to be able to kind of not only say the word, but relate to the word and be able to go to the water cooler the next day at work and,
Yep.
speak to, it makes them feel good. It makes them feel that they have some financial literacy, or they have something to say, or they have a solution for a friend. And that's empowering for a lot of people. And I think that maybe it's a matter of just being sick and tired of being sick and tired. But I think, to your point as well, Peter, that social media has really helped with that. It's things like Wall Street bets, for example, that have occurred that have really created this crowding effect of fun. It's kind of more cool to know about money in a way. Gaming has done a lot. Of video games have done a lot, I think, as well. And I think the video game generation kind of coming up, and because of their relationship with, a lot of people would complain, I believe, about video gaming. Oh, you're 30 and you're in your parents' basement and you're still playing video games. But the video game culture is actually a very sophisticated culture today. And my day was, if you're 30 and you're playing Pac-Man in your mom's basement, wasn't very cool. But the games that they're playing today represent a culture that actually, I believe, mirrors finance in a lot of ways, and crypto.
Yeah, you're absolutely right. And, both gaming and social media, I think everything new people will poo-poo and they'll attack, right? But you've probably seen, there's this meme where, it's like a photo from, I don't know, the 1940s or something, and everybody's sitting on a commuter train in New York or something, and they're all sitting there reading their newspapers, every single one of them, like drones, perfect identical drones. Or when most of us were kids, you spend most of your time alone watching TV, watching really, really stupid TV that we had in the 1970s. And, it's not like the past was, all of us sitting around, debating philosophy as 12-year-olds. But meanwhile, if you look at the world today, indeed, on gaming, on social media, compare somebody reading an article for the New York Times to, on the other hand, let's say a zero hedge article, right? It's written in an approachable, easy to understand way, and then people are discussing it. They're going back and forth. It is far, far more social than what came before. And what I think is funny, particularly, is that the level of knowledge in the Bitcoin community, particularly about money, tech, it is so astronomical. And every so often, some dumb professor from some top school will wander in to, come and enlighten the plebs, and he'll just get his rear handed to him. And I live for those moments. I absolutely love it, because they have no idea how much Bitcoiners know. You'll have some guy who's a welder who he just runs circle around him. He'll be like, well, what was, Venice's monetary policy when they, it really makes me proud.
The other thing too about gamers is, on the one hand, I'm kind of making just a dumb joke, but I'm also serious. Like my age, Super Mario Brothers, what are you getting? It's gold coins. He's not going after pieces of paper with Bowser's picture on them. Like everybody knows in the video game world, like gold is valuable.
Gold, though. I don't know, Bob. What's the cost of production on the gold?
I was watching this, just really quickly, Bob, speaking of gold, I was watching this, I've become kind of obsessed with watching these New York City 42nd Street Diamond District Rolex deals on TikTok.
That sounds really good. I want to watch that now.
Oh, it's awesome. It's these Jewish guys that have got a pocket full of watches, and they show up on the street corner and they negotiate Rolex deals. And so one of the guys did this little side clip, and he took a gold Submariner, and then he took a stainless steel one, and he goes, why this watch is technically worth nothing, and what the gold one is worth something. Even though the retail on this one is $15,000 and the gold one is $30,000, this is $15,000 is technically worth nothing because of this. And he takes out a hammer and he just smashes it, right, to nothing. And then he smashes the gold one. He goes, at least with the gold, and he puts it on a scale, and he goes to the internet and prices the weight of gold and prices the weight of steel. And he goes, you can see the point, right?
Yeah.
Must be nice to be able to smash
Yeah,
Rolexes for TikTok.
I'm actually filing that away for future use as a great example of why the labor theory of value is wrong, right? So I have a watch that's worth 30 grand, and now I'm going to add a little bit more labor to it.
Yeah, we should be clear for the founders watching that we don't recommend that strategy. We're not
So
at all.
don't smash Rolexes.
Yeah.
Or try to compete with the Jews on 42nd Street. You might want to not do that either.
It's not good for the bottom line. So Peter, just so we don't, because a common complaint against guys like you and me for sure is when we complain about the system and we have some, sci-fi, somebody's going to say, well, that's how banks work. You're railing against fractional reserve banking. That's how banks work. So what are you talking about? And then, what it has to work like that. Maybe in your libertarian fantasy land, sure, right. Or in 30 years, everyone's using Bitcoin, fine. But this has to be the system for the next 10 years. So do you have any response to that sort of objection?
Yeah. So the easy part is, so I think people don't understand what a minor change it would be to go to full reserve. Empirically, about 20% of bank deposits now are in checking accounts, and about 80% are longer term, they're in savings accounts. And what you do under fractional reserve is that you would say, okay, if you want your money immediately, in other words, a demand deposit or a checking account, then that has to be backed by cash. Because the bank is telling you can have the money right now. This is like if you have a business and, you've got some guy's last paycheck. Okay, he quit, he's going to go run around the world. Good. And so you say, hey, you want to pick up your check? And he says, nah, I'm backpacking right now. Let me pick it up next Tuesday. You better have the money next Tuesday because you have a debt which is due on Tuesday, right? If, on the other hand, it's a demand deposit, if the guy can pick it up any time, if you've got tens of thousands and 100 million people who are all going to pick up their check at any time, you've got to have cash for it. So the banking system is effectively doing that. It is promising that everybody can have their money at once, but of course they don't have the money, so they are lying. They are claiming that the money is there waiting for you. Anytime you want to pick up your last check, I got it right here for you. Okay, and then people show up and say, hey, yeah, can I have my last check? Can I have my demand deposit? And the banks say, funny thing happened though. All right, and then people freak out, right? So in a full reserve system, checking accounts, any money that the customer wants immediate access to has to be held in cash. And then meanwhile, banks would be free to offer time deposits. So, for example, CDs, certificates of deposit. They might offer attractive interest rates on those, 5-6%. Why? Because they can take that money and lend it out, right? So, from your depositor perspective, you walk to the bank and he says, well, you can have, a checking account pays nothing, or and a CD will be on a specific term. So like a 3-month CD, a 1-month CD, a 5-year CD. And you would expect that to be laddered so that the longer the length of the CD, the higher interest rate they would pay because they're trying to entice you into this. And then customers would face that. And empirically, if we go by the ratios of checking versus savings accounts, about 80% of the deposit capital would be perfectly available. It would be lent out by the banks to businesses. The world would not change. Incidentally, that last 20% that would be hoarded in the bank, of course, simply transfers its buying power to the other 80. So you actually don't lose anything. Society does not get poorer. What you do is that you stop that Achilles heel of the banking system lying about bank deposit or demand deposits being in two places at once. You cut that off. That is the source of all of the banking panics because that is the foundational fraud that's underlying the fractional reserve bank system. So I think that's the most important for people to understand is that the idea here is not that a bank holds everything in cash. That would be nuts. Why would they do that? If a bank is offering me 5%, I'm not going to keep every dollar I have in case I need it on Tuesday. I'm going to lend it on a term. And I think sort of the final point here that is also important is that the question here is not the government banning something. The question here is, do depositors understand how fractional reserve works? Does grandma understand that when she puts her money in the bank, it's actually being lent out to Silicon Valley tech bros for speculative, investments in the Caymans? Okay. Because otherwise you might go to grandma and she'll say, oh, I've got my money in Wells. And you would say, grandma, why are you investing in a leveraged bond fund that specializes in... She would say, what? No, I'm not. It's in the bank. she does not understand what's happening. She does not comprehend that her money is not in the bank. It's off in exotic destinations doing exotic things. And so it's not a question of free markets. It's a question of any contract that one party does not comprehend is invalid. If you know that and you persist in trying to sell it to them, that is fraudulent. If I go to an old folks home and I hit up 84-year-old millionaires and try to sell them structured financial products, that is not a question of free market. That is a question of fraud and deception. So in my mind, it's simply a question, do depositors understand? The existence of bank runs means that they don't understand. Otherwise, why would people run? Why not just come back tomorrow when they have more cash in inventory? Right? Clearly, people do not understand how fractional reserve works. They are being deceived. And, just a final point on that is that it would actually be amazingly easy to change. There is a tiny little rule in, I believe it's FASB. It's called a suitability rule. If you've ever tried to trade options on your brokerage account, they ask you a bunch of questions like, how long have you been investing in stocks? Okay. They ask you a bunch of suitability questions because they want to make sure that you know what you're doing. Because if they don't, then that's going to be presumed by a court as fraudulent, that they took advantage of you. That's all I'm saying, is that given how people empirically understand fractional reserve, it requires suitability.
That's fascinating. That was extremely well said, and I appreciate that. I want to go back to your comment about grandma and, no, my money's in Wells, which, right. I know. It's so perfect. And it just kind of made me think, for some reason, my brain, let me just work through this for a sec. Whereas every dollar bill or every piece of US currency has a serial number. So it's kind of, to some degree, non-fungible because of the unique number that it has, the unique number, I guess. And then if you were to create an NFT, say, and then that was all tracked, and then grandma could go on the internet and see where, and then it was on the blockchain. It was upload the NFT there, but obviously it was on the blockchain. And you could see that grandma, my money's in a exotic, mortgage backed security in Cayman.
That's right. Yeah, exactly.
And she could trace it. When she goes to the bank to get it out, she could real time trace it, watching it somehow. I want my specific dollar bill with zero. Yeah.
Yeah, and that's one of the discussions in tokenization of assets, right? Whether it's through NFT or people have been trying to do this over and over. In 2008, there were a number of startups back in the ICO boom that were trying to tokenize assets. And that is really attractive for that reason, right? If you tokenize a dollar, you can also, dollars are sort of tokenized with stablecoins. If you tokenize, meaning that you have a unique representation that can be, put onto a blockchain, you can tokenize contracts, dollars, agreements. You could have self-executing smart contracts, for example. You could have a insurance product where you pay the contract X dollars per year, $100 a year. And if the weather is reported as freezing in Orlando, you are paid $10,000. Okay, so that is crop insurance. It can self-execute at zero cost. Once you've set up the smart contract, you have contracts that also have escrow, all right, and then they're all secured by cryptographic keys. You could literally set that up, and it would be an automatic, self-operating crop insurance. And you could do this for a whole range of industries. You could opt that. What you need to go into that is what's called an oracle. An oracle is some external data set that the contract believes is trustworthy. So, for example, the National Weather Service, in the case of crop insurance, you can obviously port that model to life insurance, where you have a well-known oracle in the form of death reports. But sort of tokenizing assets, I think, is very exciting. You could not only verify where your things are, so grandma could know, if her dollars running around in a bar in Pattaya or something, but you can take all of these markets that are currently not liquid. Or like if you would like to sell a 1,000 share of your house, good luck, right? The transaction costs make it not worth it. On the other hand, if you could tokenize your house, and then you could sell fractions of that, and then the buyers could enjoy some of the capital gains. You could even structure it so that they're also responsible for some of the property taxes, and of course you could infinitely structure it so that you're moving the risk back and forth. And I think that is a really exciting area, and I think it'll be fought tooth and nail because if you had a tokenized if tokenized assets were, widely used and were properly understood by the legal system, in other words, enforced, then you would essentially you would have an automatic Wall Street, right?
Yeah.
It would be self-executing.
So it's essentially what Infineo, like Bob's in my company, what we do is we tokenize real world assets. It's essentially what it is that we do. And the first asset we decided to tokenize is life insurance. So that's literally what we're doing. We when we're not in here talking to you and we're out there, that's literally what we're doing, is we're literally tokenizing life insurance and creating a NFFT, or a non-fungible financial token marketplace.
Yep.
For the global exchange of these, and so they can be traded, they can be leveraged, sold without as much, centralization and friction. But yeah, I think, Bob, I'd love to get you to weigh in on that as well. But the thing that excites me, the big arbitrage between crypto and TradFi are security tokens. And we even have, an exemption with the SEC that allows us to raise money for a security token clearly in the daylight of the SEC. We're registered with them, and it's kind of what they want. They've asked for that. They've said, here they are suing Coinbase, and they're saying to us, yeah, knock yourself out.
Yeah, to their credit, I don't think the SEC is so much dead set against crypto and tokenization in general. I think it's just that they want it to be in their, they want to get their cut. They want to have control over it.
Yeah, they want to protect. Yeah. They want to protect people. At the end of the day, like our lawyer, who's actually been on the show, is very pro SEC. He's a kind of quote unquote crypto lawyer, blockchain lawyer. He's a securities lawyer at the end of the day, but he's relatively famous in the crypto space in the United States. And he's been on the show. His name's Lowell Ness. He's very, very credible, great guy. He's a big fan of the SEC. When I first got into the space and I decided, yes, I'm in crypto, I just automatically decided to hate the SEC for some reason. And I realized, I don't even know why I hate the SEC, just because everyone else is doing it. I guess I need to. Then there's just all these vaporware Ponzi's trying to create products that were securities that they didn't want to be securities. And they're crying like babies when the SEC shows up and tells them they can't, operate in the United States or sell to Americans. Well, it's because it's a security, and they're securities, in my opinion. These things are all securities.
Yeah, I would just soon shut them all down and just go with a liability rule. But yeah,
it's interesting.
Right.
Yes, I like how you got your feet in both in the sense that you're real theoretical and knowing. Like, oh, we don't need any of this stuff. Murray Rothbard explains how an economy will work, but you also are practical. And I loved your answer. I know this. I don't know if you've written that up or if you read that for the suitability rule. I have. Yeah. I debated George Selgin in the Soho Forum on fractional reserve, but I've been reading tons of stuff. I've never seen such a succinct, because I think you're right. Just for the listeners, because what happens in these debates is always comes down to the people who are pro fractional reserve banking will say everybody knows the bank's not literally putting their money in the drawer in the bank, because how could they pay you interest? Back in the day when they actually did pay you something. So they know, and we all saw, It's a Wonderful Life. Everybody understands the concept. But I think you're right too, Peter. But then, the pushback is, okay, but then why are they so mad when the bank doesn't have my money? They call it my money. They don't say, that loan I made to the bank when they credited my checking account to show what the IOU was. No, they say my money is in the bank. It's my money. Right. And so I think you're right. If there was a survey that was just even 10 questions, most people would not pass to say, do you really get what's going on here?
Yeah. Yeah, absolutely.
I got all worked up about that.
No, I love it.
No, for sure. Yeah. Yeah.
Well, guys, that was an inspired hour conversation. I feel as though we could dive into tokenization and spend another hour. Maybe, Peter, we would have you back sometime to have a conversation.
Yeah, definitely. I would love to.
Because,
Yep.
Go ahead. Please go.
Oh, no, I was going to say, no, I would actually love to hear more about how the business is structured. For me, it's actually very interesting. I was talking about smart contracts earlier. I think that's the roadmap, sort of the ultimate destination. But I'm not very sympathetic to regulators in general. But indeed, there has to be a path to get from here to there. So the question is, how can you actually do that while creating value? But But for the record, I would just as soon shut them all down and go back to the pre-progressive era rule, which was do no harm.
Very well said. It's in my mind, and as I'm thinking about this podcast, I'm thinking about founders and business owners and the economy. And I'll make reference to my wife taking me to see Jordan Peterson in Orlando a few weeks ago. And, he's on stage and he's talking for, a couple hours, fairly unscripted. And he's just kind of working through in his mind, a chapter of his book. And that's what he said. He came out on stage and he said, this is recorded. I will use the recording of this. And it was at the Florida Panthers arena. It was sold out. Can you imagine?
Oh my gosh.
It was crazy. There was tens, maybe 15,000 people there. It was crazy.
Wow.
Yeah. And he's saying, I'm just, I'm making this, I'm thinking as I'm going, am I using this forum as a creative forum to hear myself speak and think for chapters of my book? And I'm like, what a neat kind of way to kind of get it on papers, so to speak, and he's up there just riffing, and you can see him thinking through things and challenging himself and making mistakes and going back. And it's very vulnerable. And that's why he's just so captivating. And this show, I think, in a lot of ways is like that. And just as I'm sitting here, I'm thinking, and we're having this conversation, I'm thinking about business owners. For me, I've been a founder for 30 years. I've had success and failure. And I'm thinking of, these businesses are the lifeblood of America. They're the lifeblood of all countries, really. The lifeblood of families, businesses as well. And I'm thinking, what is that future? And the idea and what just came up for me was this tokenization idea. And, what tokenization for businesses could mean in the future, in the short future. And again, me being the optimist, I look forward to, I thank you for, being involved in this conversation and helping me kind of define some direction in terms of kind of where we're going and the intent really of what it is we're trying to do here. And I think for me, what came up for me was, educating business owners more on tokenization and, fractionalizing, their businesses and digitalizing their businesses and, getting their business onto the blockchain, which is very, very sustainable. So I just wanted to thank you for helping, me work through that process.
Yeah. So I'm curious. So the tokens are representing the actual life insurance contracts, right? And each one is fungible. Each one is unique, correct?
Yeah, non-fungible. And right, there's two measurements of it that are on the blockchain, which is the cash surrender value and the death benefit. And then everything else, which would be the personal information, would be all redacted. The policy number would be there to give it transparency, but then the personal information. But those monetary values would be visible.
Yeah, I'm a huge fan of that. I think within the, let's call it the blockchain community, just to be Catholic, to be as broad as possible here, I think that there's a lot of conflict where people don't differentiate between altcoins as investments, where like people go out there and try to get you to buy, what is it, Hex or Doge or whatever. Those I think are pure scams. I think
the Hex guy kills me.
He's got the hat though, marketing. Where did I go wrong?
My God.
So okay, those enrage me. On the other hand, the use of a utility token, to me, that is comparable to Nostr or BitTorrent. To me, that kind of thing is extremely exciting, that you could port massive parts of an economy onto an infrastructure that the government cannot touch, right? That they can't censor, they can't sort of pile themselves on top. They can't necessarily even see it. To me, that's really, really exciting. So the utility token idea, I love. That my sort of internal standard is if somebody's asking you to invest in the token, But in this case, I mean, I love the idea of crypto as a decentralization, like an architectural tool to get out to sort of rebuild your own state or your own economy that has nothing to do with the state.
Yeah, totally, and it's right there. A blockchain, and there's it needs, the industry needs a little bit of liquidity right now in the primary market. I think reported roughly last year there's about $20 billion of liquidity in the space, and in this secondary market we don't really know what it is. It'd be higher than that, but there are robust marketplaces and exchanges that are SEC registered. There's one called INX in the United States. There's one called Oasis Pro Markets. Securitize is another one. And these are all any retail investor that can pass AML and KYC and go up and set up an account and start to purchase some of these real world assets. One of the most famous ones in the world is Aspen Coin, which is out of Aspen. And it's a fractionalization of the St. Regis Hotel in Aspen.
Nice.
So you can just go on, buy a token. And I think utility token is really, you're right. I've kind of forgot about that term, truthfully, because it just seemed to be, but you're right. That's what it is. I mean, it's the utility. And that back in the day when ICOs and things were around, utility tokens were a thing. But you're right. It's a security token is essentially a utility token. Well, what is it? I own I bought $10 of the St. Regis Hotel. Well, hope it goes up in value and then I can speculate on that and sell that down the road.
Right. And you could ultimately have the prospect of, for example, distributed venture capital where, somebody could open a noodle shop and they could just kind of hit up, people could buy fractional shares in this, and you could have some mechanism that, in there for escrow and reputation verification. I mean, there are a lot of really elegant elements that can be built in there. And then, of course, you have ongoing R&D and, because software, once somebody invents a particular type of smart contract, for example, that then propagates at near zero cost, right? So the R&D in the space, I think, has just really been exciting.
I feel like I should mention for the benefit of listeners, they probably could figure this out, but just to make it easy, since we kind of just naturally started talking about what Infineo is doing, if you go to infineo.io, you can see we've got white papers that are being put up, and I've written some other things too that are being posted for public consumption to spell this all of this stuff out. Because Peter, it is that's how I came to be here. I did some work in the whole life sector. There's using those things as cash flow management tools for business owners in particular. And then also, as I have written stuff on Bitcoin from just an economist perspective. How does it work in terms of monetary theory? And that's why Cole said, well, we're kind of bridging the blockchain with whole life. You need to be part of this. And that's how I ended up here.
Nice.
Very cool. Well, guys, let's give the listeners their time back. And I want to thank you both. Peter, especially on behalf of Bob and I really enjoyed this conversation, and I know that I learned a lot. So thank you very much.
Awesome. Thank you, guys. Thank you for having me on. I really appreciate it.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.